I think that when gold really moves up, 5,000 or more, 10,000, $20,000 an ounce, when you get that kind of a move, I think it's because the US dollar is really, in almost a free fall. I think the dollar is going to be losing ground, and that means prices are going to be going up. So it's not like gold's going to go to 10 or $20,000 an ounce and your grocery bills aren't also going to go way up, but they're going to be much, much higher than they are now. I mean, and they're going to be going up, and it's not just food, it's going to be energy and pretty much everything that's going to be getting more expensive because we're just going to be having a run on the currency, run on the dollar. I think the dollar is going to lose its status as the reserve currency. In fact, I think if gold is anywhere near 10, 20,000, it means the dollar has lost that status.
The London gold market is currently facing a potential liquidity crisis, driven by growing concerns over the gap between physical gold reserves and paper gold claims. Traditionally, gold trading relied on a system of paper contracts, which allowed for trading without the actual delivery of physical gold. This system, which includes custodians, vaults, and clearinghouses, has historically provided liquidity and convenience. However, recent market stress and delayed gold deliveries have exposed vulnerabilities within this system, leading to uncertainty about the actual amount of physical gold in storage, and raising fears that paper gold contracts could become worthless if they can't be redeemed for tangible gold. The reliance on paper gold trading has masked underlying issues related to the true supply of physical gold, with demand for tangible gold now outstripping what's available for delivery. This growing demand has led to significant delays in the delivery of physical gold, causing concern about the ability of custodians to meet redemption requests. Investors are starting to realize the risk that their paper gold contracts could become worthless if they cannot be converted into actual gold. This situation highlights a critical disconnect between the paper gold market, which operates on theoretical claims, and the physical gold market, which is constrained by the limited supply of actual gold. The surge in demand for physical gold has further exposed the system's fragility, making it increasingly difficult for investors to trust that they can access their gold when needed. This growing uncertainty has amplified fears about the stability of the gold market, and some analysts suggest that this disconnection could trigger a major sell-off or panic among investors who realize the true extent of the supply shortages. Financial analyst Peter Schiff predicts that these developments could drive gold prices to new heights, with projections suggesting prices may reach $5,000 to $10,000 per ounce. Historical trends show gold's tendency to rise during times of economic turmoil. The current market dynamics, marked by unprecedented monetary policies and geopolitical tensions, could trigger a significant shift in gold's role as a safe haven asset, potentially reshaping the financial landscape. We present the clips of Peter's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I think gold's going to move up much faster. And I also think when they start to do that, that's when the US dollar starts to really decline on a relative basis related to the euro and the pound and the yen and all these other currencies that it's been strengthening against. And if we have $3,000 gold or close to it in an environment where the US dollar index is strong, imagine what gold's going to be trading like when the US dollar index is weak, right? Because that's when gold really shines, is when it has a weak dollar. The fact that it's been able to shine with the headwind of a strong dollar just shows you how strong the underlying trend is for higher gold prices. I think what we're headed for is going to be worse than 2808. First of all, in other countries, like you mentioned, in Australia, in Canada, they're already seeing gold move to a much higher degree. Because we're way up in terms of those currencies over the past couple of years because those currencies have fallen as the price of gold has been rising. So, I mean, those countries haven't collapsed, right? The people are still surviving this, huge move up in the price of gold. But I think that when gold really moves up, 5,000 or more, 10,000, $20,000 an ounce, when you get that kind of a move, I think it's because the US dollar is really, in almost a free fall. I think the dollar is going to be losing ground, and that means prices are going to be going up. So it's not like gold's going to go to 10 or $20,000 an ounce and your grocery bills aren't also going to go way up. They're not going to go up proportionate to that, because we're just going to be having a run on the currency, run on the dollar. I think the dollar is going to lose its status as the reserve currency. In fact, I think if gold is anywhere near 10, 20,000, it means the dollar has lost that status. People are fleeing dollars and buying gold. And in that environment, we can't run these massive trade deficits that we just reported today. So consumer goods are going to get much more expensive in the United States, which means the standard of living comes down. Interest rates are going to be much higher. This whole credit bubble is going to implode. And so we're going to have to go through a protracted economic decline. Now, is it possible that, AI and robotics and all that might, help transform the economy in the future to make it a lot more productive? Sure. But there's a lot of stuff that could go wrong between now and then. Really just doesn't agree with anything I'm saying, because he thinks AI is going to just be this complete miracle and we have nothing to worry about. He figures we're all going to be fine within the next few years. And my younger kids, they're too young to really care about it right now. they're just being kids. But you're right about what you said. The politicians are doing nothing. What's happening with Doge is good, but it isn't enough to get to the root cause of the problem. The best thing that Doge is doing is calling attention to government waste, fraud, and abuse, which is good. But the Republicans in the House just voted to pass a budget with only one Republican having the guts to vote against it. And they proposed a budget that increases the deficits beyond what they were under Biden. So the problem gets worse. And they also included a provision to increase the debt ceiling from 36 trillion, a level which we've already surpassed, right? So we're already above the ceiling, but they're going to raise it to 40 trillion. And Trump is in favor of this. This is how we got into this mess, by continuously kicking the can down the road and raising that debt ceiling every time we get to it. The fact that they haven't taken the opportunity not to raise the ceiling shows you that they're not serious about ever balancing this budget, because the only way to do it is to leave the ceiling intact and force the government to cut spending. The bull market is going to last as long as we have fiat currency, pretty much. I mean, look, when the Federal Reserve was established in 1913, gold was $20 an ounce. Now it's almost 3,000. So, I mean, this is a long trend. And it's not that gold has changed. The value of the paper money has changed. Because when we first established this country in 1789, we ratified the Constitution, and there was the Coinage Act of 1789 that defined a dollar. And gold was $20 an ounce in 1789. And so 120 years later, when we created the Federal Reserve, gold was still $20 an ounce. It hadn't changed. The dollar had the same value in terms of gold when we created the Federal Reserve. And so that shows you that gold prices don't have to go up. They can stay the same if we have sound money. But the Federal Reserve, of course, began to print too much money. And then in 1933, Roosevelt devalued that dollar, and the price of gold went from 20 to 35. And it kind of stayed fixed there, although it was artificially suppressed until late 1970. And then Nixon devalued the dollar a couple times. But when he got to about $42, he just said uncle and just defaulted. But now, the dollar has been completely detached from gold ever since 1971. And that's why the dollar's value has accelerated its decline and has gone from 42 in 1971 to 2,950 last week or on Monday. But now we've pulled back $100. We're about 2,850 now. So it's a sale.
Current monetary policies, especially the unchecked money creation by central banks, have raised significant concerns about the increasing fragility of fiat currency systems. To manage ongoing economic crises, central banks have resorted to printing vast sums of money through quantitative easing and low interest rates, with little regard for the long-term implications of such policies. While this may provide short-term relief, it also risks undermining trust in the financial system. As inflation rises, consumers find their money no longer stretches as far, leading to reduced spending, investment, and overall economic growth. The result is a vicious cycle that further exposes the systemic vulnerabilities of fiat money systems. According to the Gold Advocate, with the endless expansion of monetary supply, there is growing uncertainty regarding the long-term viability of paper currencies, which has led many investors to question the sustainability of traditional financial systems that rely on these fiat assets. In light of these developments, more investors are looking to precious metals like gold and silver. As an alternative, these tangible assets offer a store of value that isn't subject to inflationary pressures or sudden devaluation. Investors are turning to these assets to hedge against the potential collapse or devaluation of paper currencies, further highlighting the vulnerabilities of fiat money systems.
I wouldn't wait for that. It's going to be like waiting for Godot. So what you should do is just buy. This is a nice little pullback here. We got above 29.50 and now we're back below 28.50. So we've had about $100 pullback. That's about as much as you're going to get. That's how the bull market has been. You have to pay up. Otherwise you're just not going to buy it. But, silver is still very cheap. If you think I missed the boat on gold, I mean, you didn't miss it, but, you may want to buy silver. It's still below $32 an ounce. Silver is ridiculously cheap. So you could buy that right now and maybe buy gold later. And also the gold mining stocks, which you alluded to, I think that's where you should really be buying. I mean, because the gold mining stocks are not that much higher than they were when gold was 2,400. So, you could really just, take a gift horse there and just buy them now, before they eventually explode, which they will do. It's hard to say. You might have thought it was going to be these good earnings that were just released, but we got a bunch of earnings that came out and most of the stocks went down, even if they beat their earnings. But even the stocks that didn't beat, that missed, the earnings were still great compared to the prior year. So there's just so much negativity in the sector. And I think it's just because the analysts that follow these stocks don't believe in gold. They expect the price to be much lower in the future than it is today. And so that clouds their judgment for what these companies are likely going to earn in the future, what they're worth now. And I think people are making money, or at least they were until the last couple of weeks, in tech stocks and other type of stocks that are a lot more exciting than gold stocks. Have certainly performed better over the last 5 or 10 years than gold stocks. And a lot of other people have been distracted by Bitcoin, which obviously has gone up a lot over the last 5 or 10 years. And I think that's stolen some of the retail thunder out of the price of gold, and probably the gold mining stocks. Ever since all these Bitcoin ETFs were launched a little over a year ago, I think a lot of stock market investors that may have bought mining stocks decided to buy crypto stocks or, Bitcoin ETFs. I think that's going to end up being a very bad decision for them. But that may be one of the reasons why these stocks are still so cheap and nobody is really paying attention to how good the fundamentals are. They never really turned them off. They slowed them down a bit, with quantitative tightening, but money supply expanded about 5% M2 last year. So they just don't have them in overdrive like they have had, and they will. Look, initially, they used inflation to prop up the economy, to prop up the financial markets, to prop up the government. But when that inflation became so unbearable on Main Street, they finally had to do something about it, right? So, but when rates got up to about 5.25% and banks started to fail, that's when the Fed stopped hiking. And they've paused the cuts because, inflation has really spiked back up. But I think that eventually they're going to resume the cuts because the economy is going to continue to weaken. But inflation is going to continue to strengthen. And so that is the dichotomy that the markets don't appreciate. But when the Fed is faced with that dilemma, it, I think, will err on the side of trying to stimulate the economy, and they'll just allow inflation to get worse. Now they're not going to say that; they're just going to pretend that inflation is going to come down by itself, or that they've already done enough, and we just have to wait a little longer for inflation to work its way back down to 2%. But it's more likely to go above 10% than go back down to 2.
Many analysts are bullish on gold as it continues to gain momentum amid a weakening dollar and growing economic uncertainty. With inflation concerns rising and the Federal Reserve possibly implementing rate cuts soon, gold has become a focal point for investors seeking a safe haven from market volatility. As traditional financial markets face pressure, gold's reputation as a store of value is once again being reinforced. Experts predict that gold could experience significant price surges as investors flock to precious metals to hedge against the shifting financial landscape. Gold's role in institutional portfolios is increasingly becoming more significant. As major hedge funds and pension funds begin to take gold more seriously, it could trigger a broader acceptance of gold as a key asset class in institutional investment. The entry of large-scale institutional investors into the gold market could provide substantial liquidity, pushing gold's value higher and cementing its place as a staple in diversified portfolios. Share your perspective on gold's role as a safe haven in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.